over time, the way I think about a career is filling in different spots in the bingo card. And so any new role that you're going into, you want to think about, is it going to be a different business situation and a different set of technical challenges that I've had? And then how do I build that out over time? Some of the best advice I've gotten on that front was Mark Hawkins, who has this phrase of, if you're going to get 10 years of experience in your career, make sure it's 10 years of experience and not 1 year of experience 10 times.
Ooh, that is really good. That is really good.
Is this thing on?
Yesterday's price is not today's price.
Hey everybody, welcome to Run the Numbers with CJ. This is a awesome interview coming straight at you. I interviewed the CFO of Klaviyo, Amanda Whalen, and they did a very brave thing last year. They went public when other companies were not. We go through the criteria that her and the management team looked at to pull the trigger and go public in a macro environment that was not the hottest. They still performed really well. We go through valuation criteria that CFOs may use to figure out what a company should be worth. We talk about the bankers, how they decided to lead left, who would be on the cover. That's my dog, Walter, who's growling below me for another treat and loves IPOs. We talk about how dual voting shares work, how she went about building the book for investors, and gives us the inside scoop with a funny story about the Roadshow. So for all you IPO nerds out there, we go deep into the Roadshow, the IPO process, and ringing that bell. We also touch upon the qualities of CFOs. She has this term, I really like it. I might steal it, don't tell her. The CFO Plus Role. We talk about how CFO and CEO roles are converging in a way, and the qualities that separate the good CFOs from the great ones. This is an interview you're not going to want to miss. Amanda is one of the best in the game. All that and much more after a short word from our sponsors. Okay, serious question for all my accounting pros here today. Are you doing what you were hired to do? What I mean is, do you have time to actually be a business partner, or are you buried in tedious manual tasks just to get your journal entries prepared every month? I know how that feels. Leapfin's here to help with that. Leapfin is accounting automation software that automatically prepares and posts reliable journal entries. And that's just the beginning. High-growth businesses like Reddit, Canva, and SeatGeek choose Leapfin to eliminate manual tasks, accelerate month-end close, and enable accounting leaders like you to provide faster insights that will help your company grow. If you're battling messy transaction data from Stripe, Adyen, Shopify, Apple Pay, and other PSPs, and then battling again to get it all into NetSuite, go to leapfin.com to watch their short product intro video. And if you like what you see, request a 15-minute conversation to learn how accounting automation can help you and your team. Check out leapfin.com today. That's leap like jump, fin like shark. I just made that up. I hope they're okay with it. Leapfin.com. Ready to plan confidently, close faster, and report more accurately? Here's what sets Planful apart. Imagine purpose-built applications for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks and with minimal IT involvement, so you can rapidly and seamlessly engage everyone across the business on your key financial progress. Best of all, Planful grows with you. Its unparalleled scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Oh yeah! Go to planful.com/metrics to see how you can reach peak financial performance with Planful. That's planful.com/metrics. Amanda, welcome to the Run the Numbers podcast.
Thanks so much. Happy to be here.
I've been a Klaviyo fan for quite a while as a Boston native myself, so this is truly a bucket list interview.
Thank you. We are excited to be here. The feeling is mutual. I have shared episodes of the pod with my team. Our CEO reads your Substack. We're huge fans and happy to be here.
I'm going to clip that and send it to my mom because she doesn't know what I'm talking about half the time on these. So Mom, I think I made it. Amanda, you did a really brave thing last year. So you went public when other companies were not. So what were your criteria? Like, what were you going through in your head to be able to pull the trigger and say, this is the time?
Yeah. So, we always had a saying internally that going public is kind of like a high school graduation. It's an important milestone that you need to go through at some point, but it's not the be all and end all. And the exact timing is less important than that it happens overall. So, when we look at many of the great companies who we admire, companies like Microsoft and Salesforce and Adobe, they're all public. So we knew that we wanted to be public someday. We were in the fortunate position that we were already cash flow positive. Andrew likes to say in his mind that we'd go public sometime between 2030 and the reason, or before 2030. And last year felt right to us because it was the right time for the business. We were really confident about where we were as a business. We were growing quickly. We had strong unit economics. We've got a long runway for growth ahead of us. And so that made it the right time. And then, we also thought about a few different other things. We knew that being public would provide benefits from a customer perspective. It helps increase awareness of the company, give us credibility as we're selling to larger and larger companies out there. We also knew it was important from an employee standpoint. One of our core values is that all of our employees are owners. And so it was a really important milestone from that. But number one was really all about, is the company ready and is it the right time for the business?
Amanda, I love the analogy to graduating. So if I think back, so I graduated from high school in 2009, college in 2013. In both those periods, there were macro considerations of like, what job market am I coming into? And at the time, you look at it and you say, this is like this moment is so big, or this time period is so big. But then you say, well, my career, hopefully knock on wood, it's going to be 40 years or something. Like this is just a blip on the radar. And if you look back at other companies, like you said, like Microsoft who went public, they said like, this is just part of us entering a new chapter. That if we're doing things right and we're confident, like this is going to go on for a long time.
That's right. And so the way we thought about it was really, what's the right time for the business? And as a business, where you want to be when you're ready to go public is you want to have enough scale that you've got a track record of growth. You want to have a really clear strategy of where is growth going to come from in the future with enough proof points that investors know that it's something that can actually really happen. And then you want to be planting the seeds for future growth that's going to, help you on into the future. And that's really where we were, at this point last year as we were thinking about going public. So it was less about, what exact year does it happen? It was more, what's the right time for the business? How do we make it through this important milestone? And then importantly, get back to running the business and building a generational company, because that's what it's all about.
And one of the probably underappreciated things about going public at a time when there aren't many others is you get a lot of airspace, right? So one of the big benefits is that, hey, if you want to sell to the enterprise and you want that advertisement, I mean, it is kind of like this big gala or party, or not really a political event, but you get all this, publicity. And if you maximize it at a time when there aren't that many others in the market, like that's pretty cool.
It is. It was pretty cool. We had a lot of attention from potential customers, ones who before had said, what is this? How do you pronounce your name? Who are you? And all of a sudden, the credibility that comes with being publicly listed, and publicly listed on the New York Stock Exchange, it's a big, important event. And now customers say, okay, you guys have the credibility. You're clearly here to stay. Let's talk about how we can partner together to grow my business.
And you'd mentioned it before, like the financial profile, you were incredibly cash flow positive. And so in doing my research, I saw that you raised about $450 million from inception to IPO, but I think you only needed like 15 million to get where you were at. Like that's remarkable.
Yeah, thank you. That is one of the statistics that we are most proud of. So I love that you picked up on that. And for me as a CFO, I've got to say it's one of the beautiful parts about working with our two co-founders, Andrew and Ed, is because that's how they've built the business from the start. Our belief has always been that you can and should do three things at once from a financial standpoint, that we should be growing rapidly at scale and doing it in an efficient manner. And that it's not an either or of, do I want to grow quickly or do I want to be efficient? That it takes creativity, it takes thoughtfulness, it takes intentionality, but that you can do all of them. And that enabled us to, not only grow so efficiently through our history, but to have a financial profile that investors looked at and said, okay, this is a business whose profile we like.
I mean, you as a CFO, Amanda, it's kind of rare to have founders at the outset. Like if I have three pillars here, one of them is efficiency. Was that a selling factor for you?
It was great. Yeah. I mean, for me, it just made my role as CFO so much easier because Andrew and we literally had dinner on Monday night and we were talking about this, about heading into next year's planning cycle and how do we, continue driving growth? Where is growth going to come from? And how do we make sure we're efficient through the planning process? And that's just, it's in their DNA. So it makes my job that much more straightforward.
And so we hit on it before, why go public? And some may be saying at home, like, wait, you're printing so much cash, market environment wasn't that great. Like, why do it then? You're still making money. And this may not necessarily be the criteria for why Klaviyo did it, but if we could just take listeners through. So like enterprise awareness is one benefit, employee liquidity is another. What are some other reasons why a company would want to go public?
Yeah, I mean, enterprise awareness is important. It does help from a customer perspective. It helps from an employee liquidity perspective. But the number one that I would anchor back to and that I would encourage all CFOs and CEOs thinking about going public is what's the right time for the business. And for us, it was we had gotten to a scale where we clearly, were a substantial, company. Last year, we had close to $700 million in revenue.
Yeah.
We had a demonstrated track record of growth in our core markets. Historically, we have started out primarily serving retail and e-commerce businesses and serving a lot of small businesses. But we were also starting to see really good traction in the places that were going to drive growth going forward. And for us in our business, that was expansion internationally and growth in the mid-market. And then we were just starting to plant the seeds for that future expansion of adding new products and expanding into new verticals. So it really was, from a business perspective, the right time where you had that track record, you have the proof points, and you have the runway ahead, because investors want to know that you've got the demonstrated ability to deliver, but they also want to know that there's upside so that they can share that upside with you going forward.
If I was to play that back, it was like your core engine that had got you to this point was very predictable and it was firing on all engines and it was doing well. And then what you had outlined, Amanda, were different growth vectors, whether it be segments or geographies, that there was a lot of meat on the bone. And investors like that because they don't want to come in and like you've gone through every opportunity that's out there. Like they want some runway.
Exactly. They want that runway ahead. They want the confidence that you can deliver on the runway, but they want to know that, there's plenty of room for growth for you going forward.
You'd mentioned that your CEO had jokingly said like maybe before 2030 we'll go public. In all seriousness, once you did say, I think it's shaping up to be that time. How long did it take from that first conversation to actually ringing the bell?
Yeah, I joined about 1.5 years before we went public, and we started having conversations about getting ready even before I joined. So I think one thing, for other CFOs who are thinking about going on this journey is just recognizing that the journey to get ready to go public happens long before you kick off the official process. And the way that I would think about that readiness is I would generally say, think about it in 3 different groupings. There's what we would call technical readiness, there's strategic and business readiness, and then there is investor and communication readiness. The technical readiness is all of the pieces that most people usually think about when they think about getting ready to go public. It's, do I have the right accounting systems in place? Can I close the books? When I'm subject to SOX, am I going to be ready from a control standpoint? It's, is my forecast accurate? And so right as I was joining, we were implementing a new ERP system. We were staffing up our accounting team. We actually already had in place a cadence with our board where we issued guidance once a quarter and then judged ourselves on how would we perform relative to that guidance. And we started doing that a couple of years before we went public. The strategic and business readiness piece I talked about, it's about, do you have that track record of growth and the growth ahead of you? And then that investor and communications readiness piece is all about building relationships with investors and telling your story. And so same thing, we started a couple of years before we went public, going out to conferences, meeting with investors, getting to know them, not only at conferences, but on non-deal roadshows, and getting practice in how do we tell the story. And then we actually put that practice even more from a practical standpoint. We started doing quarterly mock earnings calls where we wrote up our scripts. We told the story of the quarter. We got onto the phone with our board and our bankers, and they asked us questions just the same way that an analyst would. So starting to act as if we were public long before we actually kicked off the process. And then once we actually kicked off the process, I would say it was a little bit more than 6 months from officially kicking off and, selecting banks to going public. I'm super proud of the fact that when we mapped out, when we kicked off the process, we put together a project plan and a roadmap. We hit every single date on that plan exactly as planned, which folks said they'd never seen before. But I think the reason we were able to do that was because we'd started it a year or two before.
I love how you said you're doing the mock earnings calls, because it just really goes to show how prepared you want it to be. And people, I think, underappreciate the amount of work. Like, we spoke with Sonali Parekh of Ring Central, and she was walking us through how she gets ready for an earnings call. We did a whole episode basically on just how a CFO prepares for earnings calls.
Yeah.
And like, doing them before you go public is so important, because you kind of get down the rhythm of how the call goes, because people probably don't realize, like, there are certain blocks where, different people speak, and it's expected that you'll go over this, but not that. I wanted to ask, did any of your board members who were playing the analyst try to trip you up on purpose?
They asked some hard questions. They really did. They said, they asked some ones that they knew would be tricky. With them, just the same way that we actually do today, we're very metrics driven. It's part of why we like listening to you and reading the things that you write. We measure our hit rate on, how accurately did we predict the questions that are going to come up in Q&A.
No way.
And so we score ourselves every quarter on it. The board members and bankers, they asked us some tricky ones, but we, for the most part, had them prepared.
And the scripts themselves are so important. Those can take a while to write, I know. Can you take us through, like, how you went about that? Did you have people in your group research, hey, print out a bunch of scripts from other companies that are out there, and maybe we'll try to say, hey, we like how they do that, but we don't like how they do this?
We did, and Andrew, our CEO, is also, has strong opinions on this. So we read other people's scripts. We talked to folks about best practices. We had Jack, who was our head of investor relations, was looking at lots of examples. And then part of also the script is getting into a rhythm. You want there to be enough flavor and color on the current quarter, but also predictability, so investors know what they're going to hear each time. And so part of what we were working through when we went through those mock earnings calls was getting into our own rhythm on that and finding our own voice.
I like how you said that, Amanda, because to a degree, you are training the analysts and investors listening to it to expect certain metrics and to expect certain pieces of the story to get an update on.
Right. Yeah. For our business, one of the things that we've heard from investors they appreciate is we have 4 key levers that drive our growth: adding new customers, expanding with those customers, growing internationally, and growing in the mid-market. And each quarter we give them an update on how are we making progress against each of those.
And then they probably start to echo that in their model. So what's great about that is the repeatability drives a model that actually reflects the reality of the world that you operate in.
Yeah, it does. And so that's, back to part of the reason for getting ready early is really thinking about knowing, are we crystal clear as a company on what those growth drivers are going to be so that we can be consistent over time? And then what are the metrics that we're going to use to demonstrate that so we can have consistency in those metrics? As some of our favorite investors we work with always remind me, Amanda, it's really important to be consistent. Say what you're going to do what you say. We want to have that predictability from the business.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Mercury knows your financial operations are complex. Founders and finance teams have to pull together different tools, reconcile transactions from different sources, and struggle to get accurate answers. With Mercury, you can simplify your operations with banking and software that power your critical financial workflows, all within the one thing every business needs: a bank account. And with new bill pay and accounting capabilities, you can pay bills faster, stay in control of company spend, and speed up reconciliation. Apply in minutes at Mercury.com and join over 200,000, ambitious startups that trust Mercury to provide the precision, control, and focus they need to transform their financial workflows so they can perform at their best. Mercury, the art of simplified finances. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group and Evolve Bank and Trust. Members FDIC. I'm getting good at that voice. What does the future hold for business? Can someone invent a crystal ball? Until then, over 38,000 businesses, that's a lot of companies, have future-proofed their business with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, and HR into one platform. With real-time insights and forecasting, you're able to peer into the future and seize new opportunities. Download the CFO's Guide to AI and Machine Learning for free at netsuite.com/metrics. That's netsuite.com/metrics. METRICS, metrics. Please, guys, I really need this. Cash is king. As the CFO of a SaaS company, I know firsthand how important it is to maintain a healthy AR balance. If you can't effectively manage cash, you can't service debt, make payroll, or invest in growing your business. That's why I'm so excited to partner with the sponsor of today's episode, Maxio, the leading billing and financial operations platform for B2B SaaS. Maxio helps top SaaS companies like Chili Piper, Crunchbase, and Stack Overflow get cash in the door faster by automating collections and dunning. Gone are the days of manually chasing down invoices. Join the 2,500 plus subscription businesses using Maxio, formerly SaaS Optics and Chargeify, to eliminate revenue leakage and streamline order to cash. It's never been easier to get paid. Visit maxio.com/run the numbers to supercharge your financial operations in 2024. Not only does requesting a demo using the Run the Numbers link help support this podcast, ya boy, you'll also receive a 10% discount on your first year with Maxio. Woo! That's maxio.com/run the numbers. That's maxio.com/run the numbers. I'm curious, could you hit on maybe the valuation process for the IPO? How did you come up with an initial offering price? Because everyone has to do it, but I know that there are multiple paths to get there.
Yeah, I can't get into too many of the specifics on the decisions of it as it relates to our company, but I will say, here's kind of the framework for how we thought about it, which is what I always appreciate learning from other CFOs. We were thinking about 6 different factors that went into decisions on pricing. And one of the things that was really important as we went through the pricing discussions, not just on the week of the IPO, but even in the months leading up to it, was thinking about as a company, how are we going to make trade-offs across all of those? So here's the 6. One is you want to price at a strong valuation. You also want to set expectations in a way that supports being successful post-IPO. You want to allocate to a strong core group of investors, but you also want to avoid excess dilution and not take on more capital than you need. And you want to have strong, positive aftermarket trading once you launch, but you don't want your pop to be too big. And as you can hear when I go through those, some of them are actually directly in conflict with one another. And so that for us, the valuation process was, working with our banks, talking to investors, and importantly, thinking about how did we prioritize and make trade-offs across each of those different levels and having that conversation with our management team and our board.
Okay. That's one of my favorite moments from all the podcasts I've done so far, that framework. That's the inside baseball that people come here for. Like you said, some of those are in contradiction with one another. Can you maybe just explain to listeners why you don't want too big of a valuation pop? Because some would say, don't you want the stock to just go as high as possible on day one?
That one, I would say the part of the reason for not wanting too big a pop is one of the other ones that I pointed to, which is avoiding excess dilution. Because if you have a pop, then implicitly you've left some money on the table, which means that, that's capital that the business could have raised. On the other hand, you're bringing investors into your business, and it's really important to share that upside with them. So you want to make sure that they are getting upside. These are some of the trade-offs there.
It is a delicate balance. It's like you want it not too hot, not too cold. And then you also want the news to signal that it was a positive, outcome and that it went up. So it's funny. It's almost like there's an art and there's a science to it.
That's right. Absolutely. Absolutely. It's the importance of also having really strong advisors who can help you through navigating that.
You don't have to say any specifics here, but were there changes leading up to it? And I asked because we interviewed Adam Ante, CFO of Paycor. He told this funny story of how at the last minute they were going through with Goldman. They're like, should we do it at $26 or $28 a share? And he's like, 27. And it ended up being $25 million more for the company. And it was kind of just a funny anecdote, but was the price set or did it move it around at all?
You could see through the public filings that as we went through, it moved around a little bit. Yeah.
So the bankers running the process, what are deciding factors that a CFO will look at to determine who gets the lead left spot?
Similar to the way that I talked about the process of getting ready for an IPO, not just being about once you've officially kicked it off, but it's also all of the process that leads up to it. It was the same with banker selection, which was the outcome of having gotten to know the teams across the various banks across a period of, in some cases, multiple years. So we spent time getting to know, we literally looked bank by bank, making sure that we not only had relationships with all the banks who might be in the consideration set with their banking team, but also with their capital markets team and also with their analysts. And bankers are eager to help you. And we took advantage of that as a way to get to know them and see what was it really going to be like working together. So if we had a tricky issue we were working through or something where we wanted to see some analysis, we would ask different banks to help us out on it as a way to get the experience of what was it going to be like working with these guys. We went on non-deal roadshows with different groups to see what was the experience of being on the road together. And so, by the time we actually got into the conference room, the selection process wasn't really about just that 1 hour presentation in the conference room. It was also about this relationship that we'd built with folks over time.
I like how you kind of framed it as you're playing a long-term game with the bankers there, and you're looking deeper, like at the institution that's doing it. It's not just your investment banking team. It's who's your sell side team, who's your, commercial banking team as well.
That's right. Yeah, because you have to think about, the different capabilities that each bank brings. And, some of them have outstanding advisory teams, but they don't necessarily offer commercial banking. So in some cases, you might want to have a bank who you're working with who can help you on the commercial side. The analyst is critically important. They always say you date your banker, but you marry your analyst. And so you want to make sure you are building those relationships with the analysts and know what they're going to be like to work with. And we've got a great team of analysts we work with. And they really are partners. As you're going through the process, the banking teams were extensions of our team on the inside. We had nicknames for each other. They were, but you are working together a lot. So it's really important to know that these are folks you're going to be and want to be in the trenches with for a while.
Yeah, those are people that you have to pick up the phone and maybe call at like 11 p.m. on a Friday. So you end up having a pretty good relationship with them.
Oh, yeah. Friday, Saturday, you name it.
So I mentioned the lead left, but I feel like not many people talk about like the third line in there where the unit economics aren't as strong and maybe they're not doing as much of the work. But what goes into those relationships? What are kind of like the value props for each side to be included on, the last line there?
Yeah, same thing as for the overall. There you're looking at the strength of the advisory team. You're looking at how do they complement from a capital market standpoint, and then really importantly, the analyst relationship there as well.
This is maybe a silly question, but the geographies of where the banks like sit matter at all? Like, do you actually think to yourself, like, I want a bank in the Midwest as well?
We thought about the different relationships they would have with different types of investors, of which geography is one piece of it. But we did think about having a total syndicate who was complementary to each other in multiple ways like that.
Right. I remember someone saying to me once, like, oh, well, if you want to get investors from Chicago or something, then you should probably work with this bank because that's the pipeline to get there. But I didn't know if, the world's truly global now, and that didn't really matter.
Yeah, no, it was one of the things that we thought about.
Other than bankers, what other types of advisors do you work with during an IPO?
So multiple different types of advisors. So we worked with our lawyers were important parts of the team. And so we had a great legal team who was supporting us through the process. We had accounting partners who were helping us, on the audit side and in preparing for getting ready for eventually being ready for stocks. And then we had another critical advisor for us was our capital markets advisor. We worked with Class 5 Group, and they have deep IPO experience. And so we're a tremendous help along the way. And then the other, I think important advisory role for us was our board. As we had an outstanding board before. And then as we got closer to IPO, we were adding additional board members, folks who were bringing go-to-market strategy, customer success, finance, operations, different perspectives within SaaS. I felt incredibly fortunate that I have not one, but two CFOs on our audit committee who had taken companies public before, and having that strong board who you can turn to when you say, how did you handle this situation?
Yeah.
How did you think about framing this? Was just incredibly important.
Would you mind touching on the work that capital markets group does? Is that investor relations related, or am I getting that wrong?
It's a little bit investor relations related and a lot helping just to navigate the overall IPO process. And so helping think through what's the timeline going to look like? How do you think about structuring the syndicate? Really playing a strong advisory role to me as the CFO, because this was the first time that I had been through an IPO and that group had been through hundreds. And so, I just had great experience of here's what's going to happen next. And then I think the other thing that you're doing it with this the podcast right now is building a network of other CFOs. I had a group of CFOs who primarily ones who our investors had introduced me to, who had taken their companies public, who same thing, I would call them on a pretty regular basis and say, okay, now we're entering this phase. Walk me through how you thought about that. And the CFO community is so incredibly helpful to each other. So definitely tap into the network of other CFOs as well.
Yeah, what do they call it? Having like your own kitchen cabinet?
Exactly.
So this one's more of a technical question, but how do dual voting shares work? What are the mechanics of that?
Yep. So the mechanics of the dual class is that our co-founders and our pre-IPO investors hold shares that have higher voting rights. And the reason for having that is that it lets us focus on the very long term and be making investments and making decisions that are going to help us build a generational company over many, many years. And so as we put in the structure, we put it in a way that was very similar to what other tech companies had done. So we looked at other examples from companies who had IPO'd over the last decade and put in place a very similar structure, including an important provision, which is that it sunsets at 7 years after the IPO.
Oh, okay. I never thought about it that way. So it kind of gives you the stability or security to know that the choices you make today, like I'm making them for the long term. I don't have to like play into necessarily some like activist investor or a hedge fund that may be, short or something like that. Is that how to think about it?
Yeah, it gives you that ability to be focused on the long term. But again, importantly, it's not forever because, right. That I think is really important to investors as they're looking at it, knowing that, there's also that accountability.
I think Google and Facebook were two of the ones historically who, it was news when they did it, but now it's becoming more commonplace.
Yeah.
How did you go about building the book for investors? Because like I said, you didn't actually need to raise that much money heading into IPO, but I imagine you still had a lot of relationships with, investors who wanted to get in. So what was your kind of thought process of building that book of different types of investors?
Yeah, our thought process was, as we talked about before, we had started getting to know investors well before we actually headed into the roadshow itself. So by the time we started the roadshow, for many investors, it was the second time or even the third time that we'd met those investors. And that was really important, both for us and for them, for a couple of reasons. First is for them, they're making an investment in you. This is a lot of money that they're putting into the company, and that requires a lot of trust. And building that trust doesn't happen just in one meeting. And so we wanted the chance to get to know and build those relationships and that trust over time. And then the second is that we wanted to get to know them because investors don't just bring funding. The great investors are great partners to the business. They give us really important perspective and really important guidance because they've seen and they think about so many different companies and they've seen good execution, they've seen bad execution. And so because of all of that, they've got really good and helpful ideas about how to create value. So for us, it was us getting to know them getting to know us. And then at the end of the day, it's just a tough process. We were so fortunate. Our IPO was significantly oversubscribed, so we had to make a lot of tough decisions. But, we were really thankful that we'd had the chance to build all of those relationships and get to know each other.
Is there like a target mix that you go for, and everybody says they're long investors these days, but like the long investors, institutional, like mutual fund type, financial sponsors versus the hedge funds? Was there like a mix you were looking for?
For us, it was based on those things that we talked about before, of just getting to know investors over time and the relationships that we'd had.
All right. So give us the inside scoop. What's a roadshow like?
Oh, the roadshow. Such an adventure. So roadshow started on a Monday.
Okay.
Ran through the following Monday. And then we priced on Tuesday and we started trading on Wednesday. We kick it off. It opens on day one with a big group meeting with the sales teams who are going to be out helping you sell throughout the process, walking them through the business. And then it's a series of, one-on-one and group meetings with investors across the country. We went to, I can't even remember right now how many cities we went to. It involved a lot of travel.
More than 5?
Not that week, because I think we had done testing the waters in some of those things before. So, we tried to make sure that wherever we could, we'd been able to meet with investors in person. And so some of those we did before testing the waters and some during the roadshow itself. But we did do ours for the most part in person. That being said, anytime you are in person and you're traveling, it comes with adventures and headaches that come with travel. And so, one of our funny stories during the process was we had done our first day in New York. We were supposed to fly up to Boston for our second day. Our headquarters is in Boston, so it's where Andrew, our CEO, lives. So he had packed for the day for New York. And then our flight to Boston got canceled. And there were no other alternatives to get up there. We thought about, driving or taking a train, but the weather was really bad. It turned out it was going to be impossible. So we ended up staying in New York. But Andrew only had a day's worth of clothes packed because he was supposed to be going home to Boston. So we made a quick call. We talk about banks being your partners. We actually had to make a quick call to one of the bankers on our team and say, we think you're about Andrew's size. Can we have your shirt?
No way.
So literally, one of the members of our banking team gave us, the shirt off his back. He did technically go home. They were clean and pressed shirts, but someone else's monogram on there.
That's a great partner. Oh man, thanks for sharing that story. That's awesome. I want to transition into talking about the qualities of CFOs. You had used this term when we were preparing for this. It's called the CFO Plus Role. Can you break down that term?
Yeah, I think the CFO Plus is that the role of a typical CFO these days has evolved. So it's not just about reporting the numbers. The numbers matter deeply, and we love our metrics, but it's about how do you use those metrics to really be a business leader? Play a key part in not only reporting the news, but how do you set the overall strategic direction of the company and work with the CEO and the entire leadership team on, where does the choices and the strategic direction of the business. So, I think one of the biggest parts of that is having a real customer focus as a CFO. So before I even started at Klaviyo, I had talked to customers, read customer reviews, understood the things that they liked about the product, the things that we can be doing differently. I try and talk to customers on a really regular basis because it just gives you that perspective where you're not, just the one who is telling what's happening on the P&L. You're really helping to think about how do we drive this business and this P&L into the future.
I like how you hit on understanding the product because that is so core to actually understanding the story behind the numbers. We talked to Shruti Lanka, the CFO of Public, and she said, I trade on this platform. I was a user of this platform. I understand the data that's not just financial data, but operational data, and more importantly, the production data, because I don't feel like I can make calls in the business if I don't understand what we're selling.
Yeah, that's right. I've got a Klaviyo account, and in our leadership team meetings on a regular basis, we will go in and, work through, okay, we just launched Klaviyo AI. Let's work through how do you build an email using Klaviyo AI and how do I use it to create an automation? It's just, you need to be able to be in your customer's shoes.
Yeah, I've become more and more comfortable in the last couple of years with being the person who says, hey, I'm going to ask you a really stupid question. Can you explain this about the product to me? But I learned the hard way that you want to ask it then because you don't want someone from the outside asking you that question.
That's right.
What qualities do you think separate the good CFOs from the great CFOs?
Two things come to mind for me. So the first is an analogy that actually someone who worked for me taught me, but I think has been incredibly valuable over time, that the best CFOs are like dolphins. So one day you are up on the surface above the water, scanning the horizon, driving the business forward, thinking about, where are we headed? And the next moment you are diving deep below the surface, understanding each number. Where does it come from? How does it work? How do I have confidence that this is the right one? And the best CFOs move seamlessly up and down between the two and can pivot, not just from one day to the next, but from one moment to the next, from this big picture, long-term strategic thinking to highly operational and detail oriented. And the other thing that I would say is the best CFOs who I have known and worked with are amazing talent developers. I'll call out specifically Brett Biggs, who I worked for at Walmart, was just incredibly thoughtful and intentional about how did he build and grow and develop his team. And I've seen that same thing, Carol Tomei at Home Depot, Mark Hawkins at Salesforce. They are just, not only great business partners and great operationally, they're also great developers of long-term CFO talent.
Speaking of talent, I've also come to appreciate that there's a difference in the skill set of being able to recruit really well as a CFO and then being able to develop talent internally.
Yeah, I think there is. I think, you need to be able to do both. But, ultimately, I view part of my success as how many future CFOs am I helping to groom? And That's not just hiring them in. It's thinking about what skill set is everybody developing and how am I helping them round out their portfolio over time.
I love that analogy because I too think about it. Like, I hope someday my legacy is like they look at it like an NFL coaching tree of like, who came up under like Bill Belichick, like that person became a head coach someday. I think that speaks volumes about whoever they came up under.
Yeah, that's right. I will say, I'll have to give away one of my secret sauce in recruiting is I've got a group of CFOs who worked for me in prior lives who, whenever I'm recruiting someone to work on my team, I say, don't just take it from me that I will help develop you into a CFO. I'd like you to call these 4 people and here are their names and their numbers. And they're all amazing CFOs in their own rights.
That is such an unfair advantage. I love that. But it took a lot of hard work to get to that point. So well deserved. Well, speaking about developing talent versus recruiting, how do you balance the need for specialized knowledge versus, going deep on only a few topics? Because there are a lot of people out there, and I get this question a lot, like, CJ, to become a CFO, I'm not sure if I should position myself as someone who like knows 1 or 2 things down pat deeper than anybody else, or if I should kind of be a jack of all trades.
I think it's important to get a mix of breadth and depth. And the way that I tend to think about a career and the way that I tend to coach people to think about their careers, to think about your career as almost a bingo card. So it's got 2 axes. One axis is probably the things that you're thinking about and asking about. How do I get exposure to all of the different technical parts of being a CFO, right? So have I worked in FP&A? Do I have a deep understanding of accounting and controls? Have I had exposure to tax, to treasury, to investor relations, to M&A? And then importantly, I'll lay out a controversial one on there. Have I had some experience outside of finance so that I have empathy for what does it mean to be trying to lead a business on a day-to-day basis? And then the other axis is the things that you might not think as much about. It's more the type of business and the situation you're in. Have you been, part of a team leading a company through hypergrowth? Have you been part of turning around an underperforming team? Have you had to lead a major systems integration or a major change transformation? Have you been part of M&A integration? And, over time, the way I think about a career is filling in different spots in the bingo card. And so any new role that you're going into, you want to think about, is it going to be a different business situation and a different set of technical challenges that I've had? And then how do I build that out over time? Some of the best advice I've gotten on that front was Mark Hawkins, who has this phrase of, if you're going to get 10 years of experience in your career, make sure it's 10 years of experience and not 1 year of experience 10 times.
Ooh, that's deep. That is really good. That is really good. Amanda, you mentioned getting experience outside of finance. If you're a person who is in finance and says, I want to get to the CFO role, but maybe I take a detour for a bit, where would you go?
I would think about the business that you're in and think about what is core to that and how do I get experience in those core functions. So in our industry, I would think about, have you spent time maybe in go-to-market? So, our head of FP&A now spent time in sales ops. She actually had to build up a sales ops team from scratch when she was at one company. Or I would think about, have you spent time in product? And is there a role in product operations where you might be able to help? But just thinking about how do you get closer and get experience with working in those core drivers of the business so that when you're part of that leadership team, when you're giving, advice and counsel and being that strategic partner, you have an understanding of what is it like to be on the other side.
I love how you called out the product operations. That's something that I, looking back, probably took for granted or should have dug deeper on. I got a ton of experience on like the sales operations side, deploying quota, running pipeline calls. But
that's right.
The more I've learned, like being in this seat, is how you need to understand the product and how the sprint cycles and stuff go, and how you kind of overlay resources and allocate in that direction. So I'm so glad you called that out.
Yeah.
If you were to go deep on one topic, though, to prepare to be a CFO, so someone else also told me, think about your career as like a T. So you want to have breadth across the top, and then maybe you pick one area. Maybe this isn't even a letter anymore. Maybe it's two pillars, one or two pillars to go deep on. Which one I'll ask, did you choose to go deep on it, if there is one, or would you recommend others do?
So my background, I started off with a decade at Bain & Company. So started off in strategy consulting, and therefore, from a finance perspective, I would say the FP&A and operational finance was my home. And then broadened out that T as I was the treasurer of Walmart and head of, which also included responsibility for tax.
A lot of cash there.
Wow, a lot of cash there. A lot of cash, big capital structure.
Yeah.
So, that is, my home structure. Although I would say, if I think about it and maybe take even a step back from that, if I were to go deep and make sure that you build expertise in one thing over the course of your career, it is learning how to learn. It's learning what you just talked about, which is getting comfortable asking all the stupid questions so that you know how to get up to speed on something quickly. It's breaking things down into first principles, understanding the industry, understanding the competitive environment, what our customer needs. Finance is changing so rapidly. The technology that enables our function is changing so rapidly. Our businesses are changing so much. There's no way that you're going to be expert in everything that you're going to come across over the course of your career. So the most important thing is learning, how am I going to get up to speed on this quickly so that I can make informed decisions to drive to good outcomes.
I also think there is a skill in operating in ambiguity, like that is ambiguous, just even saying that. But I think one of the big benefits is you build this confidence that I can be thrown into something. I'm just going to figure it out.
I'm going to figure it out. I'm going to be able to learn this. Yeah, you get this confidence that says, I've seen enough, back to that, the bingo card. I've seen enough that I can have a little bit of pattern recognition, and then I'm going to be comfortable in ambiguity, and I know I can figure it out. And I know how to learn because I know how to ask the right questions, find the right people. Folks are always willing to help.
Yeah. Yeah. That's why I have this podcast, because I got people on the Rolodex now. I'm going to be calling you.
Yeah.
Amanda, I'm gonna take you into what we call our long ass lightning round. So you're a successful person, but I ask everybody, what's an example of something you screwed up on the job? It could be this job or a different one.
It was right before I had my first CFO role. I was leading a post-merger integration. We were doing a whole bunch of systems implementations as part of it. And in one of the systems implementations, I just made a bad system choice. Didn't really fully understand the requirements, and it caused all kinds of operational headaches when we went live. And so, I learned very quickly, one, how to dive in and own the problem. We were hands-on getting it fixed for, a week, how to own the responsibility of, guys, this was my bad call and we're going to make it better. And, how do you take responsibility, fix the problem, fix it fast, and then figure out what you learned from it. I have not made that mistake ever again.
The biggest takeaway I took, though, is that you jumped in and said, this is my bad from the beginning.
Yeah, that's right. That's so important.
Well, why is that important for people who are trying to become leaders?
Yeah, because everyone's going to make mistakes at some point. You don't gain a lot through finger pointing. You gain actually, interestingly, I got promoted into my very first CFO job not long after that. which is a little bit ironic because I had just made this big mistake. But part of the feedback that I got was, we saw how much you owned it and took ownership and responsibility and said, I am going to get this fixed. And that builds confidence and that builds trust, even ironically, despite the fact that it was because of having just made a big mistake.
Well, I think it also shows that you're human and that you're the type of person that they'd want to work with when stuff isn't going right.
Yeah, that's right. That's right.
All right, next one. If you could tell your younger self something knowing what you know today, what would you tell her?
What I would tell her is that taking risks is risky. Sometimes they don't work out. That's the dirty little secret. Everybody tells you take some risks in their career and they tell you about the thing that worked out amazingly. Sometimes you take some risks and they don't work out, but you, over the long term, will end up in a better place because of it. And so it is worth it, even though, not everything always pans out exactly as expected.
Risks like what? Like picking your next job or role, or?
Yeah, exactly. Picking your next job or role, taking the leap and, moving outside of finance. For me, it was taking a leap in some cases and, working for companies or industries that I hadn't been in before. Some of them worked out exactly as I'd hoped, even better than I'd hoped. Some of them not quite so much, but they helped along the way.
Risks are risky. I like it. Can you walk me through your finance software stack? What tools do you use today to get the job done?
Yep. So NetSuite's our ERP. Procurement, we use Coupa and Zip. For FP&A, we use Planful. We use Workiva for our public filings. We use Audit Board for internal audit. And I would think our most recent implementation was we just put in Flowcast for close management.
Love it. Razak Jallo, CFO Flowcast, friend of the pod. That's a strong finance software stack there. You didn't implement any wrong in that one.
As I said, we learned.
Yeah. All right, last one I got for you. What's the craziest thing you've ever had someone try to expense?
Yeah, it's interesting. I don't think I've seen much. I've had people ask some questions about things that were questionable, but I guess it's a good sign of the companies I've worked with and, worked for and the people I've worked with that I really haven't seen that much that is that crazy from an expense standpoint.
I had someone ask recently if they could expense dog walking because they had to go to a conference.
I've had that type of question. Yeah. I haven't seen them actually put it through, but I've gotten the question about that.
Yeah, another one, I saw somebody actually expense jeans because it was kind of like what happened to your CEO. Like they traveled and they had to stay longer. And like, well, if I'm staying longer here, I mean, I'm balling out. I'm getting a new outfit. Amanda, this has been a pleasure. I've learned so much from this, and like I said, big fan of the company, and appreciate you being generous with your time.
Thank you so much. So happy to join.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.